Welcome everyone to our last webinar. There we go. Welcome everyone to our last webinar of the second marathon series. Welcome for those of you who are joining us from all around the world. My name is Anastasia and I'm an ATAS expert in order flow and volume trading. You've been together with us for the past 6 webinars, and today is a final one, which is going to be dedicated to the questions and answers. So today we will be exploring all the answers to all the questions that perhaps got accumulated throughout the previous series of webinars and also throughout the first marathon, because this is the second series of our marathon. So before we're going to get started, please can you let me know in the chat if you can hear me and see my screen and see myself. So the quick tech check before we're going to get started. And if you can hear me well, if you can put a plus in the chat, just to make sure that everything is working fine as per usual. Okay. I see 1+, waiting for more confirmation from everyone. Thank you. Thank you for the feedback. Fantastic. Lovely to see the feedback. Amazing. So everything is working fine. Hello. Hello. Good to see you. Fantastic. So please go ahead. Let me know in the chat. Where are you beautiful people, beautiful traders following our marathon from? Which country, which city are you from? How long have you been trading as us? How long have you been with ATAS platform as well? And throughout the past 5 webinars, this is the 6th webinar of the second marathon series, we explored and went in depth on many topics, including the market context. So how to identify the market context, in which state of the market are we? We talked about their AMD, so accumulation, manipulation, and distribution periods of the market. We dove deep again into the topic of volume and volume profile, following up on the first marathon series where we just got familiar with volume profile and basic setups. We also talked about recognizing market manipulations. So how to recognize market manipulations, how to not get trapped, but also not only that, also how to use it for your own benefit, utilizing that tool, which is called the cumulative delta in the ATAS platform. We also explored how to combine something that is called the VWAP, right, with the footprint and volume profile for the advanced analysis. We also talked about how to combine all of this in a one profitable trading system and how to optimize your system and run backtesting using the replay in the ATAS platform. So we walked through the very basics to the advanced knowledge in the past webinars, not only of this series, but also the first series of the marathon. So this is a 2.0. We had 1.0 before. For those of you who watched it, you know that we walked from the very basics to the advanced, and now it's time to put all of this together in practice. So we in ATAS, we don't only want to know that you got the theory, but also that you can take this theory and apply it in practice, and you can be profitable using the ATAS platform. So please let me know in the chat if you have any questions, because today's webinar will be dedicated specifically for questions and answers, right? So I can share my screen, I can walk you through the setups and how I analyze the market, how I build scenarios for the week ahead, for the day ahead. But I'm very sure that we have questions left over the previous series as well, because we did have them every single time in the end of each webinar. Some of them I could answer, some of them I couldn't because of the time or because it wasn't the topic. So now it is the time. Okay, so make sure that if you have any questions, you feel free to put them in the chat. And in the meantime, slowly, I'm gonna be sharing my screen, so we can also see all the tools that we walked through in practice. So we have about 55, 60 minutes for this webinar to answer all the questions. So please make sure that you use it to the fullest, because I know that questions appear, especially, it might look like everything is clear when you are listening to the webinar. And if this is so, I'm very glad, because you essentially can, it means that I'm doing a pretty great job explaining, but you still get more questions when you start applying those things, when you start trying to make the profitable trading decision based on all the topics that we've discussed. So now it's a time to make sure that you can confidently use those at any time, at any moment in the market, no matter what's happening, right? We have a CPI coming out yesterday. We had the PPI released today, and utilizing the methods that we talked about in the previous marathons, you could actually find very interesting profitable setups in the past days as well. I trade using the same principles of volume profile, order flows, including cumulative delta, volume profile every single day of my life. And I'm going to be honest with you that when I started trading almost 9 years ago at this point, I was using the pure price action, the pure trading methods that are quite common and indicators, and I've tested lots of different things. And only when I started using the order flow, when I discovered volume profile, it clicked, because it answered my question why. It gave the context and the meaning and the explanation to why is the price moving the way it does. Because I was always lacking the answer to the question, okay, I understand that we should be buying, right? But why should the price be reversing there or here, right? Why should this be happening? Okay, and why not the other way around? So the context of order flow and footprint was the clear answer to this question. So I hope it also can become one for you. And for this, you do, please make sure to ask any questions you need. I see already a couple of questions in the chat. I'm going to be sharing my screen in just a moment from my second machine, and we're going to get started. Okay. Fantastic. Okay, first things first. Let me walk through a couple of questions. Good afternoon. Good afternoon. Yes, this is the last webinar of this specific series. For more announcement for the next webinars, please make sure that you follow the ARAS Telegram channel, you follow the ARAS newsletter, and we're gonna bring more of the content for you, more education, more value. If you have any suggestions for ARAS on which webinars to bring, on which topics, please feel free to contact the support, send your suggestions over, and we are going to be more than happy to listen to your feedback as well, and what can help you as well to become better traders. Hey Void, good to see you. Okay, let's get started with some questions. Good morning from the East Coast of US. Good morning, Namsa. Good to see you here. Thank you for joining. We want more webinars and seminars. There will be more. Please contact support at us if you have any suggestions, and please follow the blog and also the Telegram channel of ARAS. It's pretty easy to find. A link is always in the description, so subscribe there. All the announcement about the next webinars will be there as well. Francisco, thank you so much for the kind feedback. I do hope that the previous webinars were extremely valuable. Okay, let's get started with the first question. Here we go. My first question is, how do you calculate your stop loss if you have to think very fast? And let's say your max contract can be 5 on M and Q. How do you open the trade with a limit order? Now, first things first, the question is, how do you calculate it? Or how do you manage your risks? Let me approach it from two different sides regarding the answer. If you are asking, how do I place my stop loss? There are two methods that I mix to be able to place my stop loss, okay? The first method is mathematical. So for every single asset that I trade, and let me share my screen right here. So for every single asset that I trade, I have the special calculated average size of the stop loss. So if I trade, for example, GC, which is in front of you on my screen right now, then the minimal size of the stop loss for the GC gold futures is 40 to 50 ticks for me. So it's a minimal size of the stop loss. So when I trade GC, by default, I do not play the stop loss less than 40 ticks on this specific instrument. How do I know this? It comes from the back testing. So you take at least 3 months of data, so the past 3 months, and you backtest every single trade that you take. Now, from the entry point, you measure two things. you measure how far did the price on average go against you maximum, and how much on average the price goes in your direction from your entry point. You measure essentially the biggest potential stop loss and the biggest potential take profit for every single entry, and you find an average by calculating their, and divided by the amount of trades. This is going to give you an idea on what is the minimal stop loss size and maximum take profit size that you should be using. For example, if I take a trade randomly, let's say I have 39 ticks on gold on average, the price goes against me. And I know that, let's say, 75 ticks on average, the price goes in my direction. What does it mean? It means that my stop loss needs to be bigger than that the price can go with the volatility, not reaching my stop loss, and then come back into my profit area. It also means that my take profit needs to be smaller than 75 ticks. Why? Because I want to make sure that the trade hits my take profit before reversing, and I don't get in the situation when my take profit is missed by 1 or 2 ticks. Okay, it's kicking my screen share out for some reason. So I want to make sure that the trade doesn't miss my take profit by 1 or 2 ticks and then doesn't reverse against me again. So my stop loss needs to be bigger than the average size of how much the price goes against me from the average entry point that I take, and my take profit needs to be slightly smaller than the average. Okay, so mathematically, this is the approach I take, and I calculate it for every single asset that I trade. So I trade 6B, 6E, 6J, I trade gold, I trade sometimes 6S, right, 6C. So I trade currency futures, I trade gold, and I trade S&P 500 sometimes. So those are the assets that I trade. And for every single one of them, I have the calculation. So for gold is, for example, not less than 40 ticks. For currencies is not less than 20 ticks, okay? And for the S&P 500 is also not less than 45 ticks. So far in this current volatility, it might change. If it changes, you can adjust it. Now, the second also way, how do I combine placing this method, right, with placing a stop loss, is I place it always behind the volume zone. And let me show you an example. Like, for example, here, this is 6B. Now, let's say that I take a trade, and I was taking this trade yesterday on the CPI release as well. Some of you have seen it also in my report about that too. So if I take a trade here for the CPI, right, the price went below the dynamic level. I take a trade after the price made a squeeze. Now, my stop loss is going to be not less than 20 ticks that I told you. Now, the question is this 20 ticks enough for me to place my stop loss above the volume zone? Because I don't only want my stop loss to be more than the average, I want my stop loss to be behind the volume, because essentially I use the volume as a wall from which I expect the price reversal. So I don't want to place my stop loss right on the volume zone or slightly lower, because I'm risking that the price is going to go there, hit my stop loss, and then reverse. So I have the bare minimum of what the size of the stop loss is for this specific asset. And then I can add 1, 2, 3, 5, 10 ticks, depending on where is my volume area. So in this case, for example, I had the 20 tick stop loss, but I see that there is a squeeze and the market volatility can be high. So I'm going to add a couple of ticks. So that's approximately 22, 23 ticks on stop loss that I was using for yesterday's trade on 6B for short. Okay, so does it make sense? Please let me know if it answers your question, on the stop loss placement. Now, regarding how fast you can calculate it, right? You can use a calculator for this, but also you can just pre-calculate it in advance. And you can pre-calculate it in advance. You know that, for example, you have the average stop loss of 20 ticks for this specific asset, and you know that you can maximum trade 5 contracts, and you want to risk X amount of money. So you divide it and you pre-calculate the amount of contracts that you trade for this specific asset with the stop loss that you already have. So it's pre-prepared, right? Though in any case, if you take a trade, you need to be able to have everything ready. So the stop loss size, the potential targets, all the scenarios of how you're going to behave when the price goes in your direction, how you're going to behave if the price goes against you. So you need to have all these questions answered, including the size of the stop loss and the size of the trade before you take a trade. Because at the moment you take a market, like a decision to enter the trade, your main objective, your main focus is to make the best quality possible decision. So you enter the trade in the correct timing, right? In the best possible moment when you analyze it, at the right time, at the right place. So your focus needs to be on the execution and then on the trade management, not on the risk management, because this needs to be already pre-planned ahead of time. So let me know if it answers the question. Of course. So essentially what I do is I go and I use a replay in ATAS to backtest all my entries throughout the past 3 months on this specific asset. And let's say, okay, I take a trade here, right? I take a trade here. And then I measure, okay, from this point, how much did the price go against me? 20 ticks. And let's say on average throughout the 100 trades, it's 20 ticks. So I know that my stop loss needs to be a couple of ticks higher so it doesn't hit it before going in my direction. And then let's say my take profits throughout the past 100 trades average is 50 ticks. So I know that my take profit needs to be a couple of ticks lower, smaller, to make sure that the trade hits it before reversal. Okay, so that's a tick. That's a tip for you. Okay, that's a tip for you. I was looking for the word, and that's mathematics. And then I make sure that it's behind the volumes on the stop loss and before the volumes on the take profit. Hey, Maxwell. Good to see you. So I think I was answering this question already before, actually. Now it's in our chat as well. But I'm gonna post this in our chat later on as well. So regarding the adding to the position, now it depends with the stop loss. Okay, if I take a trade, first of all, I take a trade with a very small risk. I take a trade approximately with a 0.2 risk per trade, with an allowance myself that this risk can increase to up to 0.5% per trade. How can it happen? If I take a trade, for example, here yesterday. Okay, let's do this again. I'm going to share my screen again because for some reason it kicks it out sometimes. StreamYard is having some issues. So if I take a trade yesterday here, for example, and my stop loss is like we talked about before, like 20 ticks, for example, then this is my initial stop loss placement, right? Now, if I add to the position, for example, when the price breaks this volume and I add to the position somewhere here, if I'm on time to edit, I want to make sure that my stop loss still makes sense, right? My average entry from here to here is going to be approximately in the middle now, depending on how much I'm going to add, right? But my average entry will be worse. So now I have a question. Do I adjust my stop loss or do I keep it where it is? If my initial one was, let's say, here somewhere. So in this case, I wouldn't adjust the stop loss and I would keep it where it is for one simple reason, because all of this is my volume zone from which I'm expecting the rejection. So the price could still go here and my trade still wouldn't be invalidated. So what would be the point for me to adjust my stop loss and bring it lower if I want my stop loss to be always placed in a space where it's going to invalidate my whole setup? So in this case, I would keep it where it is. And that's exactly the reason why I take a very small initial position, approximately 0.2% risk per trade, allowing myself to then add to this position and increase the risk as the trade goes, right? Because I know that I can add to the position, sometimes to the winning trade, and it's not always going to be that I will be able to adjust my stop loss placement. So in this case, I wouldn't. Now, in which case I would adjust my stop loss placement, like for example here. And this is another trade that I was also taking earlier. So for example, I take a sell here, right? The price goes like a little in the drawdown and then comes back. Now, if I take a second trade here, for example, then I'm going to bring both of my stop losses for both trades for the average entry. I'm going to bring above this high, not above this high initially. If my initial stop loss was 20 ticks somewhere here, I'm going to bring it above this volume zone because now the price came here, rejected my dynamic level, rejected my high volume node, and starts going down. So my objective is, as long as the price is below this zone, my trade will be valid still. Okay, my trade still will be valid. Now, if, for example, later I add another position here, when the price reverses and I add more position, the moment the price starts going into profit and my average entry is deep in profit, I'm going to bring my stop loss below this volume zone here. Because now my objective is, until we are below this volume zone, my short is still valid. So I'm also adjusting my stop loss according to where is the latest volume zone created. Make sense? So now my stop loss would be behind this volume zone. So if the price creates more and more volume zones, and it allows me to bring my stop loss lower to the behind the lower volume zones, if for example I'm shorting, then I'm going to be adjusting my stop loss. If not, I will keep my stop loss where it was. Eventually I'm going to move it to break even after some time. But my main objective is to make sure that my stop loss is in the place where my trade is getting invalidated. And there is no reason for me to bring my stop loss in the place where it's not going to be invalidated. So for example, somewhere in the middle of the volume. So I can take a small position. I can add to my position 50 to 20% of the total volume, which means if I take, for example, 6 contracts for 6B, then I'm going to add from 2 to 3 contracts, okay, from 20 to 50% of the total size of the volume when the price goes lower. The lower the price goes and the closer it gets to my final target, the less volume I will be adding, because the more risk there will be that the price is simply going to reverse, right? And my average entry becomes worse and worse. And every time that the price creates a new volume zone, I move my stop loss behind the new volume zone. Let me know, Maxwell, if it makes sense, but I'm going to also send the answer to our chat today. There's another question from Game Mode. You say, why do you trade more the Forex futures? Which futures are clearest to read and least unpredictable? I come from Forex. So initially, when I was learning how to trade, I learned Forex. I was trading different kind of things. I was even trading like several exotic pairs, like for example, USD ZAR or USD Mexican peso with huge spreads, but huge volatility. I come from Forex. I love Forex pairs. That's why I trade Forex futures contracts. Very good currency futures contracts. Now, besides this, I trade S&P 500 and I trade gold. And the reason I trade them is because my system performs best on them. The way I trade and the way I see the market performs best on these specific assets. It doesn't mean that it's the easiest asset. It doesn't mean that it's the most clear asset. Because what is the most clear asset depends on how you see the market. Some people clearly see cryptocurrencies, for example, and they are brilliant trading cryptocurrencies. Other people clearly see Nasdaq and S&P 500, and they are brilliant in trading Nasdaq and S&P 500. Okay, so some people trade, for example, currency futures, and they are brilliant trading currency futures. You need to find what works best for your way of thinking, for your way of seeing the market, and for your specific strategy, and it cannot be done without the proper backtesting. So make sure that you backtest first to ensure that you have the data on which assets your system performs in the best possible way. So this is the best things that you can do. So the answer is, it's just my personal preference. There is no other reason. It's not the best asset. It's not the worst asset. It's not the asset that is the most clear, right? The currency futures are definitely less volatile than, for example, indices or cryptocurrency cryptos, right? Or gold or oil, for example, nowadays as well. So it's less volatile, but I wouldn't say that it's more clear, because it depends on the period of time as well. So, for example, the last weeks before the CPI, some currency futures were horrible. Like for euro, I'm going to show you. For euro, right here, I was waiting for the short on euro for almost 2 weeks. I hit the stop loss here. I hit break even here. And then finally, I took a sell yesterday on CPI, and I was able to take profits from this. So it's not always the clearest. It's not always the simplest. It depends on your strategy, where it performs the best. It's the same as choosing the right, for example, the right time frame to trade, or the right period of time to trade, like which hours of the day, which trading session do you trade. This depends on your very statistics. So I'd say backtest it, find out what are the best stats for you on which asset, and then trade those. Okay, so that would be my opinion on that. Now, okay, Void is saying something interesting. Forex is less harsher than indices, and you can weather in the storm, and more structured. It can be more forgiven until you bind the tolerance of risk and holding trades. Yes, true, but also not for everyone. I know people who cannot trade Forex, for example. And I'm going to tell you actually quite interesting thing, that for a couple of years ago, I couldn't trade Forex. I was trading only S&P 500 and NASDAQ. And that's it. Because at that period of time, my strategy that I was using, and it was before I discovered the order flow and volume, it was performing the best on indices. So I am 100% convinced that it massively depends on the strategy. Do I check USD chart, the DXY chart you mean before trading Forex? Not always, no. Not always. I use it sometimes, but I cannot say that I rely my Forex futures analysis on the DXY. Hey, thank you so much for the kind feedback. I really appreciate it. It means a lot to me. Really happy I could help with that. Really happy I could help with that. Okay, let me go through another questions. When a trade is invalidated, once again, it depends on your on your system that you trade. So for me personally, the trade is invalidated when it goes behind the volume and the order flow zones that are used for my entry. So if I'm shorting here, and I was looking for the 6E short in the morning. So if I'm shorting here, I don't want the price to go behind this gray zone of volume. And this is approx 40 ticks, so that's a massive size of the stop loss. But if I need to place a big size of the stop loss, I'm going to place a big size of the stop loss because that's my volume zone. So if the price goes above this volume zone and above this margin zone, the trade is going to be invalidated, because my idea is that this volume zone should hold the price and let it reverse. If the price goes above the volume zone and if it holds, it means that the big market players the buyers were able to push the price through. So the activity of the buyers was strong enough to be able to break this zone and push the price higher, which is the opposite of what I want, which is the opposite of my initial trade ID. So that's when my trade is getting invalidated. Let's have a look at the different situation, like for example 6B, right, earlier as well. So yesterday, my volume zone is the gray zone here. So this is the volume zone that I'm taking, right, the trade from yesterday on the CPI. Now I don't want the price to close above this volume zone. So my trade is going to be invalidated if the candle closes above 34.71, because then it means that the buyers were strong enough to push the price above the volume and hold the price above the volume. So I know that the idea that I had for a short is most likely getting invalidated because there is a very small chance that the price is going to continue lower after that. So answering your question, for me personally, the trade is invalidated when the price breaks and holds above there or below, if I'm buying, right, a volume zone or the footprint zone, the order flow zone, which I used for as a bias, as a reason for entering the trade initially. Okay. SI is asking, I trade crypto, but I want to start to trade macro and mini contracts. Which brokers are available for me? Is it going to be futures or CFD? Your availability of brokers depends on the country of your residency. That's first. Secondly, unfortunately, I cannot suggest you brokers. Okay, so I cannot advise you which broker to use. Which brokers are available, once again, you would need to check with your own residency. And if you want to trade, for example, the standard and micro contracts, then of course it's going to be futures, right? If you trade contracts, then it means that you trade the futures contract. So the available brokers you would need to check personally. Unfortunately, I cannot advise you on that. Okay, that's another question from Francisco. When the price has been an uptrend and has a P-shaped profile, when it comes to balance, I'm waiting for a pullback, aiming for the first cluster under the value area. Lately, it has not fallen so much. When a price in an uptrend has a P-shaped profile, when it comes back to the balance, I'm waiting for the pullback. Francisco, you need to explain me more. Are you waiting for a buy or waiting for a sell in this situation? Because I don't understand if you wait for a buy from the P-shaped profile in the end of the move, or are you waiting for a sell when the price falls below the P-shaped profile and then bounces back from it? So are you looking for a short or are you looking for a long in this situation? And then I would be able to explore the answer more, because it's lacking some context for me to answer the question properly. Do you trade in the point of control? Well, the answer to this question is actually in the first webinar, the first series of marathon. It would be the best also if you go and rewatch the first marathon. The link to the first marathon is available on the ADAS YouTube. So there is a whole playlist with the first marathon. And one of the lessons of those is actually where I was explaining the basics of the volume profile, as well as how I trade from the points of control themselves. Now, if in short, answering this question is I do not trade when the price is consolidating around the point of control. So I do not trade this kind of situations when the price is right at the volume and it's consolidating. What I wait for is I wait for the price to go away from the volume and then come back to it. Like, for example, let me open again 6E. Like, for example, here. So I wait for the price to go away from the volume, come back to the volume, and make a boomerang move. So every time I have the high volume node or the point of control included, I wait for the boomerang move, for the price to go away from the volume first, and I want the price to hold either above or below the volume, and then only I take a trade. So I never take a trade when the price is right at the volume. Okay, I never take the trade when the price is right at the volume or consolidating around the point of control, consolidating around the high volume node. It's not what I want to do. I hope this answers the question. Okay, let's see more questions. Where was this? Last one here. Okay, in the consolidation, when we observe aggressive selling pressure, decline in CVD, but the price keep range, but how do we know is absorption or a distribution? Well, it's of course it's an absorption. So if the price is consolidating and the cumulative delta is moving somewhere aggressively, but the price stays in the range, it's an absorption. Let me show you an example. This is the chart, the 4-hour chart of gold. Let's have a look at this from the end of April 2025. What can we see from the end of April is that cumulative delta started aggressively declining. So we see that the price has been consolidating during this time, and it didn't move almost anywhere, barely anywhere, while the cumulative delta has fallen from the minus 4,000 contracts, so more 4,000 more bids and asks, to more than 73,000 contracts, more aggressive bids and asks, which is immediately telling me that we have pretty much a very big disbalance on the bid side, and aggressive sellers are accumulating their orders in the market starting from April 2025. Now, at the same time, the price didn't move anywhere. So as we can see, the price has been consolidating in the same area since April. So it didn't move and it didn't renew the all-time highs, and it also didn't fall. At the same, this automatically means that something is holding the price from falling. Now, what is holding the price from falling? Every time that the price doesn't fall when it should, it's because we have a buy limit orders absorbing the aggressive activity of sellers. So we have the buy limit orders under this zone, which are absorbing the sell by market orders, not allowing the price to fall. To clearly understand this concept, you need to watch the first video of the first marathon, where I was explaining on the depths of market, how the orders are getting felt. So when you trade in the market, right, in the futures market, your sell by market orders get matched with buy limit orders. Your buy by market orders get matched with your sell limit orders. So they match together. And this is how the price moves or stops. So if there is, the delta only shows you market orders. So that's up, sell by market orders massively here, which match with buy limit orders. Buy limit orders absorb the sell by market orders, not let the price fall, however, keep the price higher. So this is an example of absorption, always. Always, when cumulative delta is moving somewhere aggressively, but the price is stuck, it's an absorption. Let me know if that was the answer. If you have any more questions regarding this topic, feel free to post them in the chat. I'm here to help as much as I can. Okay. To answer this question, MM, I need to know which time zone are you talking about? Around 10, which time zone? 10 a.m. Lion, of course, this is why we are here. So this specific live is dedicated for the questions and answers. So you can ask all the questions. Please feel free to do so. That's why we are here today. Maxwell, if it comes to the CVD and vertical volume, for me, it would be S&P 500 and gold, perhaps. If it comes to the cumulative delta, the bigger, I think, the better moves are made, specifically on gold, perhaps oil, S&P 500, maybe NASDAQ. For currency pairs, is slightly less, because the currency market, the currency futures market, is such a liquid market that it's the principles of especially vertical volume and the spikes of the vertical volume are less visible and less frequent. Whereas you can immediately see the spike of the vertical on the vertical volume indicator in indices, in crypto also, in gold, in oil as well. So I would say those assets are better if you combine cumulative delta with the vertical volume. Namsa, good question. So how I do it is during the weekend, I do my overall analysis and prepare for the scenarios for the beginning of the week. So over the weekend, I analyze the weekly, daily, and 4-hour timeframes and see how the market was closed, how the price closed compared to the volume last week, last day, last 4-hour candles. Based on this, I built my bias within the direction for the upcoming week and a few scenarios for the start of the week. Now, those scenarios that I build during the weekend usually work out or don't become valid at all in the first 3 days of the week. So Monday, Tuesday, and Wednesday. Of course, during the week when the price already moved and the context has changed, especially as if we had, for example, the important data release like CPI or PPI, or the new information on the tariffs or geopolitical events, of course, I change my bias. So during the week, I usually do reanalysis and build new scenarios for the continuation of the week. So over the weekend, to summarize it up, I do the analysis for the first 2-3 days of the week, and then throughout the week, I update it with more context from the market already. I'm trying to not miss questions. There are many questions, so I'm trying to not miss them. Okay, Francisca. So when we are in a balanced market, now let me elaborate what the balanced market is. The balanced market is the consolidation. That's a balanced market. Market is balanced approximately 60 to 70% of the time, and then it goes from one balance to another, like it goes surge to another balance when the context of the market changes, right? It again kicked me out. So it changes with the macroeconomical, geopolitical events, and so on and so on. So now the balanced market is when the price is ranging. It's approximate agreement between buyers and sellers where both of them feel like the current market price is fair for this specific asset. I do not trade in balanced markets at all. So I never take a trade in the balanced market, in the consolidation. The reason for this is when you trade the balanced market, you actually always have 50-50% chances on where the price is going to go. Beside this, you might get stuck in a balanced quote-unquote market in the consolidation for a very long period of time until something changes and the price goes searching for the next balance. So I personally don't see the point of trading within the balanced market. I don't trade within the balanced market. So if you feel like if you're opening the position in a balanced market, unfortunately, it's not part of my trading system, and I just don't see the point in it. Of course, if you're a range trader, you might have a specific system for it, but I don't trade this. I trade when the market is imbalanced. I trade when the market is in the move, in the trend, until it finds a new balance area. So following this question, I open the position when the price leaves the balance, so it exits the balance and comes back to the volume, tests it, and then I open the trade. Okay? So for example, if you watch the first webinar of this series, we were talking about the AMD model, which is accumulation, manipulation, and distribution, which is, for example, what was happening on pound on the weekly time frame. Apologies. So what we had in pound on the weekly time frame is exactly this scenario. So we had accumulation, manipulation, and then distribution. Okay, manipulation, accumulation, and distribution. So I start entering trades in the manipulation zone and in the distribution when the price leaves the balance, when the price exits the range and starts going in the specific direction. This is when you can already analyze the future direction, because if the price is located below the volume, you will be looking for shorts, because the majority of the volume will be above the price, and it's going to be most likely acting as a resistance, holding the price from going up. If the price is going to be above the volume, you will be looking for longs, because the volume below the price will be acting as a support, absorbing the seller's activity, not letting the price falling. So it depends on the volume, but if the price is in consolidation in the balance, it's in the volume. It's literally in the high volume node, because the consolidation is the high volume accumulation zone. So I personally do not trade in accumulations. I don't suggest doing this if you trade based on volume, right? If you trade based on different strategies, of course, you can have a very profitable trading system based on, trading, for example, trading your, basically trading inside of the range. But if you trade only based on volume, it's not enough for trading in the range. You can apply, for example, the value areas, you can apply it and connect it with, for example, the footprint, and then you can create a profitable trading system for sure. But I personally don't trade in the ranges. No, I do not use the fair value gap in my trading, and I don't use the concepts of ICT at all in my trading. I trade the per market auction and everything combining, and with all the ways to visualize the market auction theory and the volume distribution. So this was a question that I was answering right in the beginning. So it would be better if you would go and rewatch it. It was the first question of this webinar. I'm sure you're going to be able to find it in the recording as well. The first 10 minutes was dedicated to answering this question. Now, regarding this question, this is a very important question, great question. Thank you so much for asking it. Now, a lot of traders live in the illusion from the Instagram pages and all of this, that traders can be consistently making the same percentage every single month. Now, as long as you are aiming to make the same percentage every single month, you are most likely going to be an unprofitable trader. And the reason for this is that not every month will be the same for you. Not every month will be profitable, and the sooner you accept it, the better it will be. The reason for this is that it might be the market conditions. It might be the changes in geopolitical events. It might be also just seasonality and the market liquidity. Your strategy will perform better in certain months. Your strategy will perform worse in certain months. It can be just your personal matters, and sometimes life happens and you can focus less. So you will also be affected by those things, which also going to influence how you make your trading decisions. So in the end of the day, you actually, you really need to ensure that not that you're profitable every single day, not you're profitable every single week or every single month. Your main objective as a trader is to stay in the game long enough to make sure that you still have money when the good moment, when the good month, when the good quarter comes, and you can take the most of it. If you will be aiming to make profits every single day, the only things that you will have is you will eventually be blowing the accounts, because you will be having a FOMO. You will feel in the days when the market doesn't give you any setups, any good setups, you will feel like the market owes you something. You will try to chase it. You will try to take any trade just to make sure that you make any, some kind of profits or your daily target. I have so many traders, and I've never seen any trader who had the profit goal for the day, for the week, and for the months, and try to reach it consistently every week, every month, every day, every quarter. Trading is not the job, right? Trading is not the job. And if we want the consistent, stable payouts, we should go find a job. Trading is not going to pay you every single month, every single week, the same amount. So I hope this brings some clarity as well. Because I saw this too in the beginning of my trading career, and I've learned the hard way that trading doesn't pay you consistently, and sometimes you will be unprofitable. Sometimes you will have losses. Sometimes you will have losing streaks, losing periods. and it's a part of the game. And the sooner we accept it, the sooner you find peace with it, the sooner you are fine with it, the faster, ironically, you become a profitable trader. Fend, great question. So I use daily or weekly, or 44 hours. So it's the same, 4 hours daily and weekly, depending on period on which time frame I can see what I need to see better. Sometimes it's going to be 4 hours, sometimes it's going to be daily, sometimes it's going to be weekly. And then 30 minutes and 5 minutes correctly. Now, during the weekend, I do the analysis exclusively on the higher time frame and on the 30 minutes. So I analyze the context on weekly, daily, and 4 hours. And then on their 30 minutes, I built my scenarios. Now, during the week, I trade on 30-minute time frame and combination on 5. So let me explain you how I do this. For example, if we go to the high time frame, right, on the same 6B, for example, I was waiting for the short on 6B already from the last week. Some of you have seen this also. For some of you, we broke it down together. So I was waiting for the short, and I had several target zones. I had this target zone, and this target zone as a point of control. Now, on the weekly and the daily, I built my bias and scenario. So I know if the price closes below the certain volume zone, my bias for the next upcoming week will be short. And my task then throughout the week on the 30-minute time frame to find the good short opportunities, entries for short. So once I build my bias and the direction that I want to trade throughout the next couple of days, I move on to the smaller time frame. So in this case, for the 30-minute time frame. On the 30-minute time frame, my objective is to wait until the price enters the specific zone that I marked up on daily and weekly. So I marked up on the daily and weekly, and then I wait until the price returns to this zone. On 30 minutes, I see if the candle holds or breaks this zone. So if it holds, and I have the confirmation that the price is holding this zone, okay, then I'm going to start looking for the 5-minute time frame confirmations to enter the trade. So let's summarize it quickly. I use daily, weekly, and 4 hours to determine the directional bias. And I use 30 minutes to confirm when the price enters this area, if it holds or breaks the zone. And when I see the confirmation 30 minutes, I use 5-minute footprint and range XV charts, 5-minute or range XV, depending on the time and the asset, to confirm the timing of the entry. So I use the footprint to see the activity of buyers and sellers and what is the best time for me to enter this trade. Is it time already now? Should I wait a little longer? Or what should I do? Okay, so this is a combination of daily, 30-minute, and 5-minute that I use. In what time frame can I see the divergence between CVD and the price? You can see it on any time frame. I use it either on weekly, daily. So for example, like I was showing earlier, gold, right, on the 4-hour time frame. So for example, I'm showing gold on 4 hours here. And I see the disbalance between the cumulative delta over a longer period of time in the price. And for the entry, I use it on 5-minute time frame. To go on 5-minute time frame, I have my cumulative delta here. So I can also see the difference and divergence between the cumulative delta and the price. So for entries in the smaller time frame, for overall bias direction analysis, it's a high time frame like weekly, daily, for example. Those are the things that I'm using. Also, you can use the range XV charts, for example, for the divergence with cumulative delta, and they work perfectly in ADAS. If you want to turn on the range XV charts, you can go here and choose a range XV. For currency pairs, I use range XV 4. For gold, NASDAQ, S&P 500, oil, I use range XV 6. Hi Lou, I do not trade the red news releases in the sense that I don't really pay much attention to it. Now, the thing about the news is that price usually deliver, like the news usually deliver the price where it's supposed to be already. So I don't trade the news in any different way than I trade my average trading system. The only things that I do is managing the risks differently, but and managing, for example, the position when it's open differently. But I do not trade it in a different way than I trade my normal trading day without the high impact news release. When you trade volume, most of the time the news just deliver your price to your next volume zone. That's what you will start seeing when you trade volume for a while. No, I'm not bearish anymore on GBP USD. Actually, for the 6B right now, I'm looking for the reversal. So it reached my final zone. Let me show you again. So it reached my final zone just now on the PPI, and now I'm going to be looking for the reversal back to the upside for 6B actually. So if you look at this, it was right here, my final zone. This was the first zone target. This is the second. And now the third one is 33.69, 33.70. And if you go on the 30-minute time frame, come on. If you go on the 30-minute time frame, I'm waiting for the price to reverse from here. So that was the final zone. And I am waiting for the price to, from this zone already, to start going up for 6B. So no, I'm not bearish anymore on 6B. There is a chance that it's going to still go back, retest specific zone here. But overall, I'm not bearish anymore. Majority of my trades are in London. So 90% of my trades, 80-90% of my trades are in London session. And the rest is in New York, the first 2 hours of New York session. Do you take mean reversal trades in the scenarios where the price ranges below the volume and spikes up with data release catalyst? Show the opposite bias. I'm gonna show you this trade again from yesterday. Here, so the price was ranging below the volume, exactly this, right? On the news, it spiked up. How I traded it, I waited until the price comes back down below the dynamic level and below my volume area. So the moment I saw that the candle, the wick was squeezed to the upside, but still holding below the volume afterwards, I took a reversal trade yesterday on 6B. So that was the example, I think, of the trade you are talking about. And yes, I trade those things sometimes. Now, this is another one from yesterday as well. This is 6E that I was waiting for. Similar situation. It hit my break even. First, because I was already short earlier, so it hit my break even, then it closed lower. Cluster search appeared, so I saw that the candle closes below my volume zone, below the recently created cluster search. The price was, like you said, Void, ranging below the volume before, and I took another sell here yesterday on 6E as well to this one, to this zone, so I closed it here. So these kind of situations I take. Now, objective for me is to make sure that the price is holding below the volume then in this case. Actually, trading should be the most boring job. It really should be very, very boring. It should be boring. Let me find out the questions. Okay, we're gonna have another 10 minutes and then we are going to slowly be finishing our webinar. So I'm gonna try to quickly answer as many questions as I can, okay? So Francisco, to be quite honest with you, I'm not using this feature, and the best who can help you with this is support. You can message support on email or send them a message on the Telegram. There is an English Telegram support group. They get back to you very fast. They are very supportive, very responsive. Our team is working hard to answer all your questions. So the best way, if you want to link alerts, is to ask them. I use an alert on specific small things, but not linking them all together. I'm not sure how it would work if you want to link all of them. Specific alerts for the indicators you can find if you go to the indicator settings, for example, right? So, and you can find an alert on, for example, crosses, right? So if you go, for example, to the dynamic level indicator, you can find an alert here for when the price approaches the alert. You can find the distance. You can change, you can put an alert on when the level changes, when the dynamic level shifts up or down. So you can also put an alert for this. You can put an alert when the price reaches the value area high or low dynamic. So you can choose an alert for the specific individual indicators. If you want to link them, please reach to support, and I'm sure they will be able to assist you better with this. Thank you, Fan. Thank you for the feedback. I'm happy I was able to answer your question and give you some clarity. I use stacked imbalance indicators always on 5-minute time frame. So NEMSA, I use the 5-minute time frame always for the stacked imbalance. It's always there. Here we go. So for the stacked imbalance, I have it always just on the smaller time frame. I use several dynamic levels. As you can see, this is a daily one. This is a weekly one. I also have the black one, which is a monthly one, right? The only things that I don't use frequently is weave up. So for the rest, I use and dynamic levels, and I use the TP1 market profile, and I use the cluster search, and I use cumulative delta. And the more confirmations I get for a specific setup, the better it is for my, for my setup, and the more confident I will be taking the trade. If you want to see the distribution between asks and bids, so to see if it was an aggressive, like a buyers or sellers in a cluster, you go to the cluster search, and instead of calculation mode volume, you select the calculation mode ask, for example. And then now, well, you obviously need to change the filter then. So now every cluster search here, for example, will be showing you only the asks. So only asks above 150 contracts per cluster. Let me reshare my screen again. And if you search bid accordingly, it's going to be showing you only the amount of bids, 150 contracts and more per cluster. So I use them as a volume. So when I trade, I use the volume setting, so the total bid of asks and bids. But you can divide it basically by asks and bids separately. Then you can add, for example, 2 cluster searches, one for ask, one for bid, and select different colors, so you know when it's an ask and when it's a bid executed in the market. Captain, I honestly don't recommend risking 1% of the capital per trade. If you do this, you need to be very confident in your trading system, very confident in your risk management. You need to be having a very long track record, especially if you're a beginner trader. I don't recommend risking more than 0.5% of your capital per trade. Think about this in this way. If you lose 10 trades, you're going to be approximately minus 10%, depending if it's a losing streak or you had winning and losses. Now, if you lose 1%, right, you remember that you always need more to recover than to lose it, because it's I'm looking for the word in English. It's a mathematics, basically, right? So the faster you lose, the more difficult it will be for you to get back, just mathematically. So for the beginners, just to be confident, comfortable with your strategy, not affected by your emotions, I would say 0.5% per trade is more than enough. That's gonna take a long time, so I'm gonna just give you a couple of tips. because this is a separate webinar. So perhaps we can host a different webinar with Aras on the topic of dynamic levels, for example, in the future. But I use dynamic levels as tracking the trend. If the dynamic level is getting lower with the price, it's supporting the downtrend, and I use it as a resistance to take sell trades from. If dynamic level is growing with the price, so it increases with the price, I'm using it as a support for the price, and I take it buy trades from that. No, it's not Maxwell, it's not probability, it's a difficult, I'm gonna tell you now what I was saying before. Just 1 second. Compound effect, Maxwell. Compound effect is exactly what I was looking for. It's a compound effect. So if you lose fast, you will need more trades to recover from this afterwards, and it's going to be more difficult for you to recover. Coming back to dynamic levels, I use them as a support if the price goes higher and dynamic level goes higher together with the price. And I use them as potential confirmation for the buy entry as well. The opposite also applies if the dynamic level is falling together with the price. I'm going to be using it as a resistance, and I might take a trade at a short from those levels. Now, if dynamic levels are crossing, right, and they are too close with the price, like for example, let me find some example where I would not take a trade. Like for example, here, two dynamic levels are like too close to each other and the price is in between dynamic levels. I don't take this kind of trades, and I don't trade in this kind of situations, because usually it means that the price will be consolidating. So for example, here as well, if the price is in between dynamic levels, I don't take this kind of trades. Don't trade within them. So I want the price to be either below all dynamic levels or above all dynamic levels, and to have the distance from one dynamic level to another so I can take a trade. Ali, of course not. Like, you don't even think that you're gonna have ever 100% win rate for a longer period of time, right? For a longer period of time, you're not gonna have 100% win rate. No one does. And if you are still aiming for the very high win rate, you're confused about the win rate, and you are thinking that you are not doing too well, you can check the win rate of the, for example, hedge funds, the big financial institutions, and you will see that their win rate is approximately 30 to 40%. So you can aim in your strategy for either the high win rate and the small risk to reward, or the smaller win rate and the high risk to reward. Both of the strategies work, both of the system approaches work. You just need to figure out what works best for you, right? Of course, ideally to have a high win rate and a high risk to reward. We can always aim for the better. We can always improve. We can always strive to become better, more consistent, more profitable, higher amount of wins, reduce amount of losses. But you are not going to get to 100% probability and the win rate for a longer period of time, because sometimes it's not going to be you. Sometimes it's going to be the market, and the market situation is going to change, right? And it's fine. Like, you need to be able to accept it, work with it, be confident, even when the market is not doing well, and your strategy is not performing as expected. Captain Tell, the best time frame is the one that is the most profitable for you. I know people who are extremely profitable on the, for example, 5-minute time frame. I know people that are extremely profitable on daily time frames. Some people are more profitable on 30-minute time frame. I use a combination. I think personally that the best way is to be able to approach the market from the overall bigger picture. So to see the overall picture and to make sure that my intraday setup is in confluence with a bigger picture, I use the analysis on weekly, daily for hours over the weekend, and then 30 minutes and 5 minutes throughout the week. So I want to make sure that my trade ID that I'm taking is in as much confluence with the overall bigger picture as possible. So that's my opinion. Even for scalpers, sometimes people ask, like, but why, if I'm a scalper, why do I need to look at the high time frame? Well, maybe as an idea is you want to make sure that you're not trading against the bigger trend. if you're not trading against the bigger market structure, so you are making sure that you are aligned with the bigger perspective of where the price is going. So I'd say the combination of timeframes and the top-down analysis works in the best possible way. Okay, perfect. I got to the last 2 questions in the chat. I appreciate every single one of you asking. We've been together for right now more than an hour already. So unfortunately, we will need to slowly be finishing off our Q&A today. The next webinar, Game Odyssey, will be announced in the Aras social media. So please make sure you subscribe to the Aras Telegram channel, to Aras blog, to Aras emails. You're gonna get notified as well about the next webinars. Thank you so much for being here with us throughout the past 6 months. We talked about the market context. We learned how to utilize the tools like volume profile, VWAP, footprint. In the first webinars, we also learned how the market auction works, how the footprint works, how you use the smart tape and the depth of market in Aras platform. All of those tools can be a very strong foundation for you, for your trading success, for building the profitable trading system. But remember that no tools work if the trader doesn't work. So you are your biggest advantage. You are your biggest support, and your biggest, also the strongest instrument in your toolbox. So make sure that you take all the knowledge from these webinars and from the past webinars, from the first marathon, put it together and go back test. In these webinars, we also talked about how to create your own trading system. We talked about the elements which every single trading system needs to contain. So make sure you go rewatch them. The recordings are available by the same links that you received in your emails. And the playlist will also be published soon on Aras YouTube channel together with the first marathon series. So make sure you rewatch them. You have everything you need to build a very profitable, successful trading system. And the next webinars are going to be coming soon. So make sure you subscribe to Aras social media. It was a pleasure to be here with every single one of you. I appreciate every single one of you. Thank you for being here. Thank you for your trust. Thank you for being with us. I thank you for the feedback. I'm going to miss you too, guys, and I'm going to see you very soon on the next series of webinars. Void, thank you so much, really, for your kind words. It truly means a lot to me. Thank you so much. Guys, have an amazing rest of the trading week, a profitable one. Have an amazing trading career ahead of you. I will see you on the next webinars as well. Make sure you practice a lot. Make sure that you backtest a lot. And use Aras platform, because it really, really made a breakthrough in my trading career. And this is why I'm here today. Thank you so much once again for your trust. I will see you in the next marathons.